So you're thinking about moving to Bellingham, Washington, but you're discouraged by high interest rates. Well, in this video, I'm going to share with you what I believe is the most powerful tool for you to combat these high interest rates and put yourself in a position to acquire a home without the competition that the market has experienced over the last couple of years. We're going to get started right now. Hey, if this is your first time on the channel, we encourage you to like, subscribe, and hit the bell for notifications so you can be the first to know about all the great content that we're releasing about Bellingham, Whatcom County, and all the great things that are going on here in this area. My name is Jeff Engen. I'm with MJB Real Estate Group, and every day we get calls, texts, and emails from people just like you who are considering a move to this area, and we absolutely love it. So whether you're thinking about moving tomorrow, 10 months from now, sometime in between, we encourage you to reach out. All of our contact information can be found below, and we are standing by and ready to help in any way that we can. But for now, let's talk about beating these high interest rates. All right, so let's jump into talking about where rates are, where they've been, to provide a little bit of context as to what's low, what's high, what's perhaps somewhere in between. So at the time of filming this video, October of 2022, rates are slightly above 7%. Now, from a historical perspective, going back 20 years, you would actually have to go back approximately 22 years to the year 2000 for rates to be higher than they presently are. In the year 2000, rates were slightly above 8%. The following year, they came down, and we've not seen rates this high in that period of time. Now, if we look at the last 10 years, rates have fluctuated between 3 and 5%. And if we go back to the July through September timeframe of 2021, we saw this unheard of circumstance in which rates were actually down in the twos, so 2.5%, 2.75%. And some would argue that that overcorrection into the twos is now partially responsible for this overcorrection into the 7, as at the time we were looking to stimulate the economy. Now we're looking to curb inflation. And so we've kind of gotten these extremes. More important than dissecting those extremes today is talking about what it is that you can do to beat these currently high interest rates and get yourself into the home that you want without having to pay a 7% rate. So if you've purchased a home before, or you've talked to a lender about a mortgage, you've likely heard about a buy down. Now, typically what a buy down does is it takes your rate from its current place and reduces it by a certain percentage in exchange for what's referred to as points. Now, to provide an example, if you were financing a home, a $500,000 purchase, putting 20% down, it would mean that you'd be financing $400,000 on that loan. Well, a point is equivalent to 1% of the financed amount of the purchase. So in this example, $4,000 would be 1% of the $400,000 that is being financed. That's always going to be the same. That point is always going to be equitable to 1% of the financed amount. In exchange for that, your mortgage rate is going to be reduced. Now that is variable. It could be 1/8%, it could be 1/4%. For our example today, let's say that it's 1/4%. So if rates are currently at 7%, and you were to pay 1 point, in our example, equivalent to $4,000, in exchange for a 1/4% reduction on your mortgage rate, your rate would go from 7% down to 6.75%. You could take that a step further. You could pay 2 points or $8,000 to get that 7% rate down to 6.5%. Now, big picture long term, that's probably not a great idea. And the reason is that we've got it on good authority from the pontificators in this arena, in this space, the gurus in the mortgage space, the banking world, what have you, that rates are not going to stay where they currently are and that they're in fact likely to go below 5% in the not so distant future. So does that mean 2023? Does it mean 2024? Unfortunately, none of us have that crystal ball to tell us exactly when that's going to occur, but that is the expectation. So it would not be wise for you to pay a bunch of points up front to buy a rate down on a 30-year mortgage when in fact you're probably going to refinance that mortgage sometime in the next 2 years. What would be a far better tool to employ is what's known as a temporary buy down. Now, a temporary buy down is different than a traditional buy down in the sense that it only looks to address the first 1, 2, in some cases 3 years of the mortgage by reducing the rate on that mortgage more significantly for a shorter period of time. The most common type of buy down that we're seeing in this current market is what's known as a 2-1 buy down. Now that 2-1 buy down looks to reduce the rate of your mortgage by 2 full percentage points in the first year and by 1 full percentage point in the second year. So if we use this same example, we say that rates are currently at 7% and we employ a 2-1 buy down, it means that your rate is actually going to go down to 5% in the first year of your loan, and it's going to go from 7% to 6% in the second year of the loan. So let's provide a little bit of dollars and cents context to what this actually looks like when you're securing this mortgage. So let's say today you go out and you purchase a $500,000 home, you put 20% down, and again, you're financing $400,000 at a 7% rate. If you're doing that with a 30-year fixed mortgage, your monthly payment is going to be approximately $3,065 per month, and that's going to cover your principal, your interest, your tax, and your insurance, all rolled into that one monthly payment. Now, if we employ a 2-1 buy down and your rate is reduced from 7% to 5% in the first year, that monthly payment goes down to $2,551 per month, which is a $514 per month savings over the rate as it would be the 7% rate. In year 2, when that interest rate is reduced by 1% and goes to 6% from our original 7, it's going to be a $2,802 per month payment, which is still going to be a $263 per month savings over your original mortgage rate. Now, where do the funds come from that magically take this 7% rate down to 5% in the first year and 6% in the second year? Well, that's a great question. They are either coming from the seller, which is the requirement from some lenders, or in some cases, they're coming from you. Some banks are allowing buyers to fund their own 2-1 buy down. So how does that work? Well, using the same example, $500,000 purchase, 20% down, $400,000 financed amount, we use an estimate of 2.5% of the financed amount as the approximate cost of this 2-1 buy down. So for our example, 2.5% of $400,000 is $10,000. So the cost to employ a 2-1 buy down in our example, and you'll want to talk to your lender about specifics and get down to the dollars and cents of it all. We're speaking in kind of some broader terms here, but approximately $10,000 to fund that 2-1 buy down. Those $10,000 are set aside in a separate account, and they're effectively drawn upon on a monthly basis to net out the payment on your mortgage to get back to what that payment would be if, in fact, you were still at that 7% interest rate. So the great thing about this is that those funds are being set aside and they're used as needed through the duration of the loan. So the awesome thing about these funds is that they are yours. They don't disappear. Let's say that rates do significantly improve in the first or the second year of your mortgage, and you decide that you would rather pursue and lock into a 30-year fixed mortgage at a lower rate than to continue to serve out the remaining time on the agreed upon 2-1 buy down. Well, that's great because you're going to take whatever funds remain in that account and you're going to apply them towards your refinance. So they are not lost. There's nothing but upside in this particular situation. Now, one more thing that I do want to share is if we go back to April of 2022, at that time, homes were still selling on average in Whatcom County for 10% above list price. So in our example of a $500,000 home, that means that home would have received multiple offers, likely with buyers waiving their contingencies and escalating the price of that home from $500,000 up to $550,000. Now at that time, rates had already started to increase, gotten into the 4s, and so realistically a payment at that point in time would have been probably in the ballpark of $2,500 to $2,800 per month in this same kind of example that we've been using throughout this video. So compare and contrast. Would you rather be in a situation where you have a lower interest rate and you're paying more for a home and waiving contingencies and competing with other buyers? Or would you rather have the more leisurely experience of being able to navigate the current market where homes are sitting on the market longer, buyers are more willing to accommodate your requests, and yes, you're paying a slightly higher mortgage rate, but with this 2-1 buy down, we can get you down to or below what you would have paid back when you paid more for that house back in April. This is why I think this tool is so valuable. This is why I think that now is still a great time for you to consider buying a home here in Bellingham or wherever you might be looking. As always, I hope this has been helpful to you. If you have any questions, all of our contact information is below. We would love to help with providing you information on 2-1 buy downs, connecting you with lenders, sharing more about the area, and talking about the real estate market in general. Anything we can do to help, encourage you to reach out. One more time, ask you to like, subscribe, hit that bell for notifications so you can keep up on the videos and content that we're releasing about Bellingham and about the surrounding area. Really appreciate you taking the time to watch this video. I look forward to seeing you again soon.